Okay, this is Chapter 9, the Master Budget and Responsibility Accounting. So when you do a budget, it's a plan for a specific period of time, and generally we start off with 1 year. And the reason you do this is because it helps management determine how to use resources and how to estimate future cost and revenue. So the first thing you want to start off with, you want to figure out your sales budget. So how many units of whatever product you're making do you think you're going to sell? So here we're looking at the first quarter of the year, and the company is anticipating it'll sell 30,000 units at $20 a unit. So the sales revenue is $600,000. However, for many businesses, you don't get cash for all of your sales. So in this situation, they're only going to get 20% cash right away, and the other remaining 80% is on credit, which can be received over a period of time. So sales doesn't necessarily equal cash. The next thing you want to do is figure out, well, if I'm going to sell 30,000 units, how many do I need to make? So you would normally think, oh, I need to make 30,000, but not necessarily, because the first thing you want to think about is how much do I want to have left at the end of the month? You don't want to be at zero. So in this particular case, the company has decided it wants to have 10% of this future months, in this case February sales, in stock. So it doesn't want to run out completely, because you could easily maybe sell more than 30,000 units, so you don't want to run out. So it's just a matter of having a little buffer to have some stock on hand at the end of the year or at the end of the month in case you need it. So we know we need 30,000 units because that's how many we're going to sell, plus we want to have 2,000 units left at the end of the month. So we need 32,000. But we don't need to make 32,000 because we started off the beginning of the month with 3,000 in stock. So you subtract that, and that gives you 29,000 units that you have to produce to cover the current month's sales. And you just complete the same process then for the subsequent months. So now that we know how many units we need to produce, we now need to figure out how much material is going to go into each of the units. So the direct materials. So as we've just calculated, we know we need 29,000 units, and the materials needed to make it is 5 kilograms. So multiply that out, 145,000 kilograms to make the 29,000 units. And as with the sales, of course, you don't want to finish the month with no stock on hand. You want to have some materials left. So the company has determined it wants 10% of the subsequent month's quantity. So 10% times the 102,500 gives you 10,250. So now you need 145,000 kilograms plus the 10% for the future months. So you need 155,250 kilograms. But that's how much you need to have. But you don't need to necessarily buy that much because you started off at the beginning of the month with 14,500 units. So subtract that from the 155, and that gives you the amount that you need to buy, which is 140,750, and the cost per kilogram is $1.50. So the total cost of the direct materials you need to buy to make your 20,000 units is $211,125. And then you repeat the same process for the subsequent 2 months. So to get our 29,000 units, you're going to have to spend $211,000 in materials to make them. The next thing we have to look at is the labor. Someone has to do this work to put the units together. So the labor is more straightforward calculation. So we know we have 29,000 units we need to produce, and it's going to take 0.05 direct labor hours. So it's 1,450 hours times $22 an hour will give you 31,900. So that's relatively straightforward. So now we have the materials, we have the labor, so we have another category that we have to calculate is the manufacturing overhead. So that's the general overhead cost of running your manufacturing facility. So there's two categories of overhead. There's variable cost and there's fixed cost. So the variable cost are indirect materials, indirect labor, and utilities. And in any problem, you would be given the information that it's the cost of each one. So for the materials, it's $1.25. Indirect labor, it's 0.75. And utilities is 0.5. So it's a matter of multiplying each of those times the 29,000 units. The next type of manufacturing overhead is fixed cost. So fixed, it doesn't matter how many units you make, the cost is going to be the same. So you can see here depreciation is the same across the 3 months, insurance and property taxes $3,000 a month, indirect labor, utilities, and so on. So you have your total manufacturing costs of $102,500. The final category is your operating expenses. So this would be more or less your administration type of cost. So here, your operating expenses is linked to the number of units you're going to sell, not the number of units you have to make. So there's two types of operating costs. There's variable cost, which will increase in relation to the number of units that you're going to sell. So your sales commission is $1.50 per case. Your shipping expenses, $2, and your bad debt expense, 1% of your credit sales, and your variable, so that will give you your total variable expenses of $109,800. The next category is your fixed expenses. So the fixed expenses would, in this situation, the salaries here, this would be the salaries for your administrative types of positions. So these people are on permanent salary, and it's not related to how many units you sell of something. They're going to be employed regardless of how many units you sell. So you have the category of salaries, office rent, depreciation on your administration offices, advertising, phone and internet. So that adds up to $33,000. So the two categories, variable and fixed operating expenses, that comes out to be $142,800. So now we have all three categories of expenses identified. So we have our direct materials. They cost $1.50 per kilogram. We have our direct labor, which is 0.05 hours times $22 an hour. And then we have our manufacturing overhead, your fixed and your variable. So the total cost of manufacturing each case is $12 per unit. So the final step in this particular process is to do your budgeted income statement. So here you want to identify your total sales. So we know it's 30,000 units. You're selling them for $20 a unit, 600,000. Cost of goods sold, we've just calculated to be $12 a case. And then from here you get your gross profit, your 600,000 less your 360. Then subtract your operating expenses, which we've just calculated, would give you your operating income. And then, of course, you have to deduct your income tax on that to come down to a net income of $63,180. So most of the problems that you will be doing for this chapter won't involve calculation of income tax, but for the occasional problem where it does, you'll be given the tax rate. So in this example, you're told that it's 35% of income before tax. So all of the numbers we just talked about, that was all done on an accrual basis. So the next type of calculation you want to do, so now that you know how many units you're going to sell and how much it's going to cost you to make those units, the next thing is to look at your cash, because as I mentioned earlier, sales doesn't necessarily equate to cash coming in. So we had our cash budget from the sales, the cash sales from our sales budget. That was the first one we did, first slide. So that comes out to $120,000. So what you're being told here is that in the month of January, you are collecting the cash portion of January sales. So you're getting $120,000 for what you've sold in January. Then in January, you're getting cash coming in from the December sales. So 85% of the sales made in January, you're not actually going to get paid for that till February. So the 85% of the cash, 85% of the sales that you did in December, you don't get the money for that from your customers until January. Then also in January, you're getting 14% of the sales that were made in 2 months previous in November. So the cash that you're collecting for sales in the month of January equals the percentage of sales, cash sales in January, plus what you're getting in January for December sales and what you're going to receive in January for November sales. So the total cash coming in is $612,200. And you would do the same thing then for the subsequent 2 months. So we're not finished the cash budget, so that was just the cash receipts. Now you have to look at your cash payments. So you're buying your direct materials, so here you're looking at the amount of cash you're having to pay out in January for your direct materials, and how much cash you're paying in January for labor. So with labor, it's always going to be the same. So the accrual amount for labor is the same as the cash, because as you know, when you're working, you get paid in the month for the work that you've done. The next category of cash we need to look at is, you'll recall, we calculated our total manufacturing overhead to be $102,500, but that wasn't all in cash. You'll recall that we had a category of expense, depreciation. So depreciation, as you know, is not cash. So you would subtract that off. Then the property tax and insurance amount, it's $36,000 a year. So from an accrual point of view, you just divide your $36,000 out over the 12 months. So that's where the $3,000 per month is coming from. But that's not actually how you pay your property tax and your insurance. It's payable twice a year. So your $36,000, you pay $18,000 in January and the remaining $18,000 in June. So what you want to do here is include for January the 6 months of taxes and insurance. So the total cash payments for your manufacturing overhead is $107 from a cash point of view. So when you're looking at the next category, your operating expenses, again, we start off with the actual expenses that we calculated, 142,800. So then what we want to do here is look for any category of expense in that calculation that's not cash related. So we had more depreciation here on your administration facility, so that's 6,000, so depreciation is not cash. And bad debt expense, when you're looking at bad debt expense, it's just an estimate of how many or how much you're going to end up writing off that you won't be able to collect from your customers. It doesn't mean to say that cash went out the door, sort of thing. So you'd remove the non-cash items. So now for your operating expenses on a cash basis, that will be 132,800. And again, just complete the same process for the subsequent months. When we look at this in total, we look at all of the cash payments. So we've calculated the cash that you need for your direct materials, the cash for labor, and the cash for overhead, and the cash for operating expenses. So there's a couple of more categories that you could have. So you might be making some capital investments. For example, you might be paying cash for some new piece of equipment for your plant. So that would be 125,000. You would be given that information, of course, in a problem. And you might be declaring dividends and paying out dividends to your shareholders. So in this case, that's 25,000. So these are two additional types of cash expenditures that you would have to account for. So now our total cash payments from all sources is 653,000. So the very final step in doing your cash budget is you want to see where you are in terms of, do you have enough cash to cover your cash expenses? So we start off with how much cash did you have in your bank account at the beginning of the month? So here we're told it's 36,100. So from our previous calculations, the total cash collections that we're going to receive in the month of January, 612,200. So the total cash coming in from all sources is 648,300. But from the previous slide there, we know we are going to have total cash payments of 653,245. So we are actually going to be short by 49.45, so 4,945. So you're going to have to use a line of credit from the bank. And in this particular example, the company doesn't borrow just the $4,900 that it needs. It actually borrows in increments of 20,000. So the minimum they're going to borrow is 20,000, and that's largely so they can have cash in their account to start off with at the beginning of the following month. So, of course, all of this is, projections, and when you're doing estimates or projections, there's always going to be a bit of variation between what you're predicting and what actually happens. But one thing businesses tend to do is do what-if analysis. So we were predicting that the company would sell 30,000 units, and so all of those calculations, all of those spreadsheets that we just looked at was based on $30,000 of 30,000 units being sold. But most companies would do some sensitivity analysis, so they would look at, okay, what is the situation going to be if I sell only 25,000 instead of 30,000? And what would it be if I sold, say, maybe 32,000 units instead of 30? So that's what we mean by what-if analysis. So what if the sales are a bit higher than I had expected, or what if they're a bit lower? So when you're looking at accounting for the different parts of your business, companies often use responsibility centers. So a company may have its budget broken down according to the different departments that are responsible for various activities. So here you could have a situation where a company has a cost center, it could have a revenue center, profit center, and an investment center. So each of these departments would be responsible for identifying their revenues and expenses. So preparing these budgets, that's just the start of the manager's process. As each month goes by, you would want to identify variances. So did your materials costs increase over what you had thought you would pay? Did the labor costs go up by more than you had planned? So the idea here is you only look at situations where the budget didn't meet your expectations by a material amount. If you're off by a couple of $100, you're not going to waste time looking for that. So it's not a matter of focusing blame, but it's a matter of identifying where costs have increased beyond what you had expected to pay. So that concludes the PowerPoints on this module.